Hello, welcome to the Capitalist Conversation. Today we're going to be talking about Reg A Plus revealed, how crowdfund investing for wealth builders and capital seekers. The four news of I've done this on crowdfunding. You're going to hear more about all of the stuff that we're doing to grow the wealth knowledge, the financial literacy of the investor marketplace, and as well as entrepreneurs. But this is a deeper dive into what I have done with the four W's of crowdfunding: who, why, what, and where, specifically to Reg A Plus. So, welcome to the Compassionate Capitalist podcast. This podcast is focused on money, capitalism, the movement of money, the use of money for launch and growth of businesses, and the potential wealth creation those founders are pursuing, and the investors that help them along the way to fuel their start and their growth and ultimately exit, where founders, investors, and perhaps employees share that wealth. My co-host, Eric Nelson, who y'all are used to seeing here with me on the Capitalist Conversations, he's on vacation with his family, so I'll be your host today, Karen Rands. And today we're diving into one of the most powerful and often misunderstood tools in modern finance, Reg A Plus. It's a powerful tool for both founders and investors. It's a gateway to investing in companies before they go public. And whether you're an investor looking for your next big opportunity before it hits Wall Street, or an entrepreneur looking to raise serious capital without relying on VCs or banks, or more than what a bank can give you, or you don't yet qualify for private equity funds, you're going to want to stay tuned for this podcast. We're going to look into Reg A Plus through the lens, as I said, the four W's of crowdfunding investing: who, what, who, where, and why, from both sides of the table for investors and entrepreneurs. I'll share a link a little bit later on about where you can get a free ebook to learn more about this and so much more, because I've got a course launching and a book coming out. I'm going to talk about some of that stuff. I'm going to tell you a bit about my story and what I'm building and why. So if you're listening with your investor hat on today and you are new to this idea of angel investing, or investing in to own a piece of private business that you're excited about the problem that they're solving, but not quite sure how to do it, how to get started, you're going to hear about the solution I'm rolling out just for people like you. And a special offer, because guess what? Tomorrow is my birthday. Tomorrow is my birthday. And boy, do I have a deal for you. And yes, I'll be sharing a sneak peek about my book. It's called Inside Secrets to Crowdfund Investing. Follow Jane's journey, a real world story of how anyone can build wealth with purpose, passion, and profit. But first, I have to give my disclaimer. Eric always wants me to do this, so I do, because it is important. This is a lot of information that we put out on a weekly basis, and it survives forever. It's evergreen. So, things change right now, and even tomorrow. The information provided in this podcast is for educational and informational purposes only. Realized I needed to check something, making sure I'm all the way up on my volume, that you can hear me terrifically. Okay. All right. Because I didn't wear my headset this time. I don't like wearing it. And I think you can hear me just fine. All right. So the views and opinions expressed by the hosts and guests are their own and do not necessarily reflect the official policy or position of any financial institution or organization. You should always consult with a qualified financial advisor or conduct your own research before making any investment decisions. The content of this podcast may include forward-looking statements that are subject to risks and uncertainties. We do not guarantee the accuracy, completeness, or usefulness of any information discussed. By listening to this podcast, you agree not to hold the hosts, guests, or any affiliated parties liable for any losses or damages that may arise from your reliance on the information provided. So there you go. Let's get into this. The what, right? What is Reg A Plus for investors and issuers? For investors, Reg A is equity crowdfunding at scale. like getting in before a company goes public. In fact, it actually is getting in before a company go public. Although, as we've talked about in the past, companies that are already public, that are thinly traded, may not be up on one of the major platforms. They might be over in OTCBB land. They can raise capital under Reg A Plus in a private round that goes in, that those people would then become part of their public market pool. But it's primarily used for companies that are private, and we're going to talk about the many reasons why. But for, I often think about my dad, who was one of those guys that always liked to look for the penny stock deal. And this was a long time before any crowdfunding stuff was legal. And so he would buy those stocks that were worth under $1 with the expectation that, they got a 25-cent stock and it went to 50 cents, he would have double his money, right? So he was always looking for those and poring over that stuff. But guess what? Inherently in a private company, particularly a Reg A Plus that is at this point and raising capital, they're going to be at this point. It is the very epitome of wholesale to retail. The difference is the runway from wholesale to retail is shorter on a Reg A Plus than it is on a startup doing a seed round or a Reg CF company or any of that, because of the nature of what they have to do and why they do it. It is by almost by definition a wholesale to a retail gambit for investors. It is equity crowdfunding, right? So keep that in mind, which is different than reward crowdfunding like Kickstarter and Indiegogo. That a lot of times people, when hear crowdfunding, they think of that. This is not that. We're going to talk about where you can find these kind of companies, and then we'll be on crowdfunding platforms that you're familiar with, perhaps for Reg CF or because you've heard about them in the news. But make no mistake about it, it is actually equity. Your dollar gets you whatever that dollar gets of equity in that company, just like it does on the stock market. So think of it as a mini IPO that's regulated by the SEC, where you can buy shares directly from these growth stage companies. The companies can raise up to $75 million from the public without going public. More on that. Penny stocks that often lack transparency, because the reason why they're penny stocks on these other trading platforms is because they don't have all their filing and their paperwork. When a company is first raising this capital, they have to have that transparency of their financials, and then they finish filing their paperwork, and then they're public on NASDAQ small cap, assuming they file all the paperwork. It's the sort of like the best of the story, right? Because they're doing all the things that they need to do in order to raise capital. That's marketing, creating awareness, marketing to their customers, growing their revenue, using that money to bring new products out, make an acquisition, whatever it might be, so that they can grow that value to be worthy of being a public company. And you as the investor gets to exit. All right. So they've got to disclose their financials, their business plans, and all the risks in a public filing. It's SEC qualified, meaning companies file this offering circular and go through legal compliance. It's not a fly-by-night operation. Now, point to be made, the SEC does not vouch for. This isn't something I teach in my course. I'm getting ahead of myself. The Compassionalist Academy, I just been going through, and even in this book, right? You see it behind me, right? Inside Secrets to Angel Investing. Even in this book, I talk about this, that just because a company has filed with any of the equity crowdfunding platforms, and even with the SEC for a Reg A Plus, does not validate their business model, does not mean that they're going to make revenue, does not guarantee anything. It just means that there's a level of transparency that you might expect from a public company. And so you can look at their financials and be able to dig into it and see, how did they use the money that they raised before? What kind of profit did they make? What are they going to do different with this money that's going to create a different trajectory than what they have, right? So that's the due diligence is still on you. Another key element of it for everybody that's listening is that it's available to non-accredited and accredited investors with low minimums, like $1,000, maybe less. You can invest in a Reg A plus company, right? Just like, you don't, a traditional angel into an angel stage deal is going to be 25K, 15K, but anybody can invest in this. Anybody that has discretionary income can invest in these kind of companies. It is a game changer. It is actually literally one of the elements of the democratization of the capital markets, right? That whole idea that we talk about where companies can raise capital from their customers, from anybody out there. They don't have to go through these narrow gauntlets of just this angel to VC, which is such a limiting source of capital for all the businesses out there. They can raise it from anybody. Okay. Same way, investors can now break free of the ties of the stock, just the stock market or real estate or even the volatile crypto, right? And they can invest in things that they're passionate about and they own a piece of that while that company is building to be bigger. That entrepreneur is working harder than anybody to succeed there, to succeed and fulfill their own dreams. And you get to provide the fuel that goes at. It's like, to me, it's just such a natural order of things, and such a, it's so copacetic. I just made that up. I'm off script, so I gotta get back on script. Okay. Institutional investors like Reg A Plus because they have the financial data and the operating history that, and odds of exit are very, very high. For the issuers, the people that are raising capital, Reg A Plus allows them to raise up to $75 million annually from the public, not just accredited investors. So it's kind of the flip flop of the benefit to the investors out there. So that opens up a whole host of where they can raise capital. So that means that it's ideal for companies that have traction and customers, because then they can go to their customers to raise capital and they want to scale. They want to stay in control, avoid the sharks that are predatory investors that can come out of some of those VC places, because if they create a really good platform to be successful at this, to raise it, so there's so many side benefits for raising Reg A Plus that you don't get when you stay within the narrow confines of the private capital markets, of angels to VCs, right? And so, because what is often the case is that the companies that are needing to do this, they kind of fall into two areas. One, which is really kind of prevalent, when you hear the old adage of 10 companies and three will be three will go belly up. This is 10 companies in a portfolio. I'm going to talk about this because Jane, that I mentioned, part of what she does in the book Inside Secrets to Crowdfunding crowdfund investing, is I take her through the journey of how she figures out how much money she has to invest, what does she invest in, and why she chooses Reg A Plus as part of her building out the 10 companies in 2 years in what I call the angel profitability blueprint. It's a strategic element of the course and the strategy. These 3 companies will just go out of business for lots and lots of different reasons. And then you always have the one that's X, or, 5X, and 4X, and a 3X, and, what they call base hits and doubles and triples and things like that. And then you got these companies in the middle. I call them the Midlands, that didn't raise enough capital to get all the way through. One of the things that angels make a big mistake on when they have group mentality and group think, and they just get it, it's easy. I teach about it in the book, how to avoid this, how to be an objective investor, but they invest emotionally as well, just like everybody does. It's a weakness that we all have. And then they'll have these companies that they haven't really fully followed into they haven't really followed uh excuse me, they haven't, I got a lot, something beeped and distracted me. They didn't really go work through the numbers. The investors didn't really work through the numbers. They just believed that this company had this market potential and all this kind of stuff, this is going to make money. And a lot of times entrepreneurs don't like to talk about what they're going to need in the future, because you have to think through that. You have to build your cap table. You have to think about when you're going to, it takes a lot of work to go through what is your product, what is it, how long does it take to sell it, what does it cost to make it or sell it or whatever, and what's the next one and the next one and the next one, and what's the business life cycle of that, and how much money will this get, how much will this get you to, will you be cash flow positive, that you were sustainable, now you need growth capital. And so a lot of times entrepreneurs particularly tech companies, will think and sometimes consumer companies, but really tech companies, they'll think they don't need as much money as will need, and they don't think that they think that they're gonna have enough revenue that they don't need this next round of capital. I try to tell them, guess what? Name $100 million company out there. Name any company that you know that did it on $2 million. It might in 20 years, but not where they're going to give an exit to those investors. So these these flatliners, they're not out of business. They got a good business model, but they don't have enough money to bring another product out to market because it takes people, it takes marketing dollars, it takes sales, it just sustaining their business. Hal Martin out of Texas, out of CTAN, on a couple of different angel groups out there. He's been a guest on my podcast, a really great guest. I had to bring him back to talk about this again. He has it where he calls it, he's the one that came up with this Midland thing, and he has a solution for it by the 3x3, 3 years, 3x your money kind of a thing. So when I learned about Reg A Plus, I'm like, how perfect is that for those VCs? Because if you think about the way a company creates value, these value propositions where unicorns are born, oftentimes it's because of the bump that the value gets when when a company goes from raising 2 million or 5 million, and now they went from a $5 million company to a $10 million company. They do work. They grow their value. Now they're a $20 million valuation. They raise $10 million, or let's say there's a 25 million, so I can do the math well, or 30 million. Okay, 30 million. They raise another $10 million. Right? So the 5 million went down, 10 million is a third of that. They've given up probably about 35% of their company at that point in time, but that 10 million gets added on top. Now they're a $40 million company in value. They grow their value. It doesn't mean what their revenue is. They grow their value because they got more products, they got more customers, they do have revenue, and so maybe they get to be a $70 million company. And they raise $50 million. Now they're a $120 million company. Still too small to go public. Okay? They can't do an IPO. And they may have missed that might have got them through a Series A, right? But they need to raise a bunch of money. They need to raise $75 million, and they can't get it from a VC. But you know what they could do? They could raise money under the Reg A Plus, take some of the money that they're making, because it's going to cost them probably $10 million to raise $75 million. By the time you go through legal fees, commission, marketing, advertising, but guess what? They get to raise capital from their customers, from their partners, from all of their investors, the friends of their investors that aren't accredited investors. They can coexist with other things like a 506c that will allow them to raise from family offices in a private unlimited amount, or they layer that in. But they create an off ramp for their existing investors to be able to exit out. It is a great way to grow the value of the company, create brand awareness, create a buzz in the marketplace. So if you don't finish the filings, the company doesn't finish filings, they'll get acquired by a big Fortune 500. So, all right, it is the solution to companies that are stuck. And that was kind of part of it for the what and the why for the for the issuers, right? But it creates a great opportunity for those investors as well. All right. So it's just so there's so much flexibility in it because it's general solicitation. That means you can general solicit anybody. You can run ads on TV, you can put billboards up, anything. So, you think about it really is all the good elements for creating a strong public offering and landing on the NASDAQ small cap. So, and for the record, from the Jobs Act, just so you know, this is getting to the nuts and bolts. The regular Reg A offering that was often used for bonds and financial products with licensed broker-dealers because of the regulatory requirements, they had to file in every state, all that stuff. They broke it up in the Jobs Act of 2012. They broke it into Tier 1 and Tier 2. Tier 1 exists as it was, which is 20 million, 12-month month time, file in all the states. You can do a pre-sell, like a test the waters. Tier 2 is up to 75 million with the SEC review of their financials. So it's an audited financial. It's best for growth stage companies with a customer base and public appeal, consumer facing brands, tech innovators, entertainment companies, companies that want to turn customers into loyal shareholders. Have you ever heard of Brewdog? They're probably one of the most known, famous ones for doing this, but there's a whole lot of other semi-name brand. They've chosen to stay private, but they can pay out dividends to their investors, so those investors are very happy. They used it's been used by consumer brands. One of the ones I always like to talk about is Chicken Soup for the Soul. It became a media entertainment company after the a group of investors bought the brand back from a dog food company to use it to create feel good movies and things like that and create a war chest. And so all of those investors share in the success of those movies, think they have their own channel, all that other kind of stuff. Clean energy, entertainment, even real estate platforms use it. So it's like creating a customer investor tribe. If you go watch the Compassionate Capitalist show, my podcast, my interview with Sherwood niece, Woody, he was one of the lobbyists that got this passed. He had coined this term investimers, and I just love it. Your investors become your evangelists, and they and their customers, they tell everybody, right? So you get a compound effect of your marketing dollars as an issuer with word of mouth if you do it right, right? And that's what Eric and I do. He does. They're going to get into what you got to do, but right now, I'm going to put a pin in it that says this is why we do this podcast. This is what we do. The mountain transfer, the filing listings, all that stuff. That is his area of specialty. I'm about the marketing strategy. Who's your target market? How do you find your target investor? How do you turn your customers into investors? How do you create your funnel? How do you get a secure portal to be able to do this? All of the investor engagement side is my bailiwick. My team is really good at that. And Eric's side is all of the regulatory compliance side, right? And then we have partners that do the legal work or the accounting work or those kind of things, right? So who is Reg A plus for, and a bit of the why, okay? So the why. I already kind of talked about my dad and what he did. So retail investors, especially those frustrated with penny stocks or overvalued IPOs, right? You think about it, and some people get hot on this buzz and they buy it and the stock drops. Or the volatility in the marketplace. Man, you can have a great stock that all the metrics, everything, all of their ratios are good and solid. They are a buy. The people out there buy. But because of random things that happen in the marketplace, trade wars, crypto dives, and some hedge fund is balancing their portfolio, right? You got all this stuff that creates churn in the marketplace for the stocks. And a good stock will drop. And a stock price on the stock market does not go up until there are more people buying it than selling it. It's transactional, just like crypto. It's just transactional. When you invest in a Reg A plus company, you're investing in a company that's tangible, that's taking your money and putting it to work to build something bigger and better, right? Public markets used to be where growth happens. Now it's private markets. And if you want early access to pre-IPO opportunities, but with transparency and regulation, right? So it's not a regular Series A of a private company because you have the disclosure of a public company. You have the disclosure of a public company, private company, the best of both worlds, right? So you transparency and regulation. So it helps to diversify your portfolio. Yes, you're going to have stock. Yes, you're going to have real estate. If you have crypto, bless your heart. But you're going to have a diverse portfolio. This is another asset class that every investor that is sophisticated and wealth wants to generate wealth is has a little bit of a risk bone in them. It's okay. I'm okay with a little risk because I want to grow my wealth and invest the way millionaires have for generations before it was legal for people like you and me. I'm an accredited adjacent, right? And so it's like, and built for people like you and me to have all the different aspects of regulation crowdfunding, of Reg CF, 506C, Reg A plus, interstate exemption. This one is truly the best of both worlds because you get to look at a company like they're public, yet they're still private with an upside. You're not going to get X on your money because they've already grown that 10 part or good chunk of that, or at least five of it, but you could get 5X, you could get 3X of your money, you could get 2X of your money. It depends on what the short run, how short the runway is of them growing their value. You want to be able, part of what I talk about in the angel profitability blueprint and in the book that's coming, and I'm going to talk at the end why there's this other book in addition to Inside Secrets to Angel Investing. Uh, is because is people want to invest in what they know and care about, right? They have this thing called ES, environment, sustainable, whatever. It's like a class of stocks that people like to invest in. Green tech, community banks, whatever. You can direct your funds directly into a company that is doing something that you admire. They're solving a problem, still as a private company. Maybe you're even a customer of them, right? Or their founders are one of those founders that part of the reason why they haven't raised the VC capital, or even beyond a friends and family round, was because that they're black owned or woman owned. I mean, it's a fact. Less than 7% of all the VC capital and angel capital go to women owned businesses. Less than 2% goes into black or brown owned businesses. And so although you can chat GPT this, women owned businesses and even black owned businesses that are venture backed outperform the white owned businesses, white male owned businesses. But it's just whatever. The door isn't open. They don't walk through it. There is still a racial and sexual bias out there in a lot of these boardrooms that, look very homogenous. And so, these VC folks, it's just the reality of it, numbers don't lie. So this is an opportunity for you as a retail investor to be able to identify those kind of opportunities if you care about that, or sectors that you care about, and the company that could be the next big thing, right? And have a real, ripple effect within the community that where they reside. And as I write in my book, Jane is an every woman investor. And as part of the angel profitability blueprint is income producing so that you're diversifying by industry and stage and type of offering. That's the core tenets while you build out 10 companies in 2 years. And so in that book, she uses Reg A plus. So she's got income producing that she's doing while she's looking for the big wins that she could do in something that she's very passionate, that's a traditional equity play, but also identifying ones that are shorter term holds. She'll exit in 2 to 3 years out of her 10-year portfolio with some return on investment. This is the reason why successful angels and angel investing is 3 times more profitable than stocks and real estate for comparable portfolios. Particularly, it's usually within the first 5 years, but definitely within 10 years when you look at the stats. And so, but people don't know about it, which is why these podcasts are important. And there's a whole nother podcast out there that I've done that tell you why people don't know about it. But she liked the transparency in the story and the privacy of this deal with more flexibility than a public listing and more opportunity for everyday investors. Sign up for early bird access for the book and discounts on the Compassionate Capitalist course. In the show notes, you'll have a link as well to, you'll be getting as part, whichever one you do, you'll be getting the 4 W's of crowdfunding investing, where I go through a lot of details and stats and things like that. But bit.ly CF for crowdfund early bird is going to be your short link to get there. So feel good about your money. Help innovative founders, especially women, people of color, and local businesses get the capital that they get denied by banks and VCs. Compound your wealth like the wealthy. This is how millionaires get richer, by investing in entrepreneurs that are working really, really hard to achieve their own dreams. If you think about it, if you are the entrepreneur, So you that are successful founders, CEOs out there, diversify yourself into other angel deals, angel stage deals, crowdfunding deals, right? Because it takes 10 years, usually, maybe more, to build a successful company. You can get a one or two multiple, a high, even a 7-figure exit in a company in 5 years. But you're not getting the 9-figure exits, right? Or the 8-figure exits in 5 to 10 years. Those take 15 or 20 years. But as an investor, you can keep your day job, be that executive in a regular old company, and you can invest in 10 different companies, 20 different companies, and get a piece of all of those entrepreneurs that are working really, really, really hard to achieve the success that they dream of. And you, along with all the other investors, this is the thing I tell people. They so often, investors and entrepreneurs will be like, oh, I never thought of it that way. So here's your aha moment. Every billionaire you know out there, Zuckerberg, Bezos, Musk, Gates, all these famous billionaires, even Walmart, okay? Even the Home Depot guy, they all became that because they had multiples. Sometimes it was 100, sometimes it was thousands of investors. So it wasn't just the employees that helped them build a company. It was the investors that fueled it when there's a gap because banks only do money for certain kinds of companies. Angels don't do pure startups. VCs don't do companies that don't have $1 million in revenue. And so all along the way, and I've already talked about the stats on diverse founders. So all along the way, any of these, happen to be that all those guys I named are all white males, but all along the way, they did it on the shoulders of a bunch of investors that became very, very wealthy along with them. They may not become a billionaire, but they put millions into their checking account as a result of investing in that business that created a billionaire. It's been going on since the Industrial Revolution in the United States. But it wasn't legal for anybody that wasn't already a millionaire, a multimillionaire, up until 2012. So that's why one of the reasons why you don't know about it as much. Okay, so compared to the volatility of crypto, the overheated real estate market, or public market chaos, this can be a new asset class for you that gives you ownership and impact. Think about that. Ownership and impact. Real companies, real offerings, SEC oversight. Okay, so on the issuer side, it's really best for growth stage companies with a customer base and a public appeal, customer facing brands, tech innovators, and entertainment. The reason for that is because it's hard to raise capital from like nothing, right? To start with nothing. It's much better to start with a customer base, with some kind of a network, some kind of online presence, some kind of something that you can get the ball rolling. Because once you get the ball rolling and you have momentum, it becomes much, much more easier to raise capital. And the institutional investors, those hedge funds, some of the ones that have roll-ups of super high net worth people that don't call themselves venture funds, they really like Reg A Plus because of the transparency, because they can look at the company and what they've done with the money that they've gotten over the years and what they're going to do with this money and where they're going to go. And they like it as a short-term return on investment. I have lots of interviews on this kind of stuff on my podcast. So companies that want to turn their customers into loyal shareholders, think of some of the ones that I've already talked about. On the issue side, the Brew Dog, Chicken Soup for the Soul, they can raise up to 75 million. Usually it's going to be about 20 million. 10 to 15, 20 million. Brewdog did raise 75 million or about 60 million in multiple increments. So it's in a year. So you can roll it over and start a new offering. And part of the reason why is because when you get an influx of $20 million and you have something that you're going to go do with it, say you're bringing out a new product, but like in Brewdog's case, they wanted to open up breweries, right? Retail establishments all over the West Coast. So it was their war chest to do that. Once they open up 5 or 10 of those, their value goes up significantly. So you don't want to raise capital at X when now your value is at Y. Raise all your capital. So you're going to raise a little bit, raise some of it at X, do what you're going to say you're going to do before you're done doing it, right? Overlap. Don't start stopped. Keep momentum going and raise the next bit. Raise the next bit so that you continue to stair step your value as you raise your capital, because you want to build awareness and value before your public offering. And so now you have a large amount of shareholders, a lot of brand awareness, because to do this, you have to advertise. You've got to do social media. You've got to do whatever's appropriate. And that's part of what we do. I have partnerships with these media folks that get you, you can get into Delta the Delta listening to on the board, or the Delta magazine, or, specialty magazines that you want to be seen in for your target market, or be able to have an advertorial in the Financial Times while you advertise your offering on the side. There's so many ways to do an integrated marketing campaign that brings you investors along with your customers. So, to recap for the issuers, you can raise significant amount of capital without giving up control or equity to a VC, because you structure the offer. You're not obligated to this stair step of value, or feeling that you're in a hard spot, rock in a hard place in negotiating with the VCs, right? Because some companies are total VC fits, but there's so many more companies that aren't. You tell the story of what you want to share your shares at. You can put in special sweeteners in it, because maybe it's an additional bump on their common shares or something like that. It's a path to public markets, but on your terms. That's really important for entrepreneurs that want to control that. And a big part of it is that we're working with a company that had gone public. It was a mess. Worked it back to go back private. Cost him a lot of money to go back private. He could have done this under a Reg A plus, but he wanted to have clean books. Now he's raising a war chest to acquire a whole lot of small companies in a technical services area that is a skilled, can't be replaced by AI, and is ripe for a roll up. He's got a very unique strategy on it. We're working with another company that's raising some capital right now in a preparation to do a Reg A plus, so that he can launch out hundreds of franchises across the country in the next 3 years. And so in both cases, they have operating histories. They're small, they're not multi-million-dollar companies, but they're doing it in very strategic ways, and we're advising them along the way. So where do you find Reg A plus deals? Where do issuers go? Where do you as an investor find them? Where? Okay, Start Engine is one. They are in the midst of merging. I thought they had merged, but apparently it's not final with Seedinvest. By the time you listen to this, it may be final. I don't know. Republic is one. These are ones that also offer other Reg C crowdfunding offerings, 506C and Reg CF and Reg A plus. You have Equifund, which is another platform. There's also local, there's organizations like a local one here in Atlanta that's going to be on the show talking about it, 1776ing, because he relates 1776 to capitalism, because every revolution is about controlling how we can make our money, who says we can make our money, and how much we get to keep. And Dealmaker, which is another one. These offer private label, secure access. So because one of the things to keep in mind, is that part of is whether there's a broker validation in that. Reg CF is a platform FINRA. They file paperwork and stuff. Dealmaker and 76er, these other ones, they file the paperwork for you and make sure that the company stays in compliance. They do not vouch for the deal. They do not raise capital for the deal. So you have to look for it. You got to get on their list. Part of what I teach in the training of the Compassion List Academy is how do you get on their list so you can find these deals. How do you discern between the deals? All of that kind of stuff, right? But for the issuers, it's important to understand one of of the things, and there's a golden nugget, I always tell companies, you must own the relationship with your potential investor. You must always have a portal that you take them through first to get their email and their name. Are they accredited or unaccredited? Before you pass them off to either, whether you're doing something on like Start Engine, Reg CF, or Reg A Plus or whatever, before you pass them off, you own the relationship, because you can spend, a issuer can spend a lot of money driving traffic to their platform, and then that investor gets on that platform and goes away. You have no idea. They may come back, they may not come back. They go to the next thing. Like, you could have a pop-up if it's on your side that says, hey, before you go, let us know your name and email so we can send you updates. Right? Can't do that on a platform. So that's one of my things that I always work with a company to set up, whether through their website, their CRM, whatever, or mine. Doesn't really matter. That's what we do. That's what you got to do, right? Because those portals do not raise capital for you. They have conditions in which they're able to send out emails to their subscriber database and create awareness, but they don't vouch for you. They don't tell people to invest in you. They don't sell your offering. And a tip is that, I mentioned that you as the investor are responsible for making sure that it's a solid investment. And so you can go look at the offering circular in the Edgar database. It should be linked from their campaign, but you can go find them and see, are they all on the side there? They're working, um, are they timely? They're up to date. Their filings. It's also, I just finished recording a lesson on this for the Compassionless Academy. So you need an issuer. What they need on a Reg A Plus, they have to have a transfer agent. That is one of the requirements. They are not required to go through a broker dealer. They must have a transfer agent. Transfer agent handles the paperwork, communicates with the investor, communicates with the SEC. That's what Eric does with Mountain Share Transfer. PPM and an offering circular. Right? We as a team help with strategy. We offset the issuers, your legal cost for validation, because we can help you create the logic behind it, and then you get them to approve it. So you get legal oversight to approve it, but you don't have to spend the $30,000 or $40,000 getting that PPM done by a lawyer, right? And of course, I already said my specialty is in the marketing strategy, investor relations, and building the onboarding platform. All very important investor funnel and communication system, because investors sometimes don't make a decision right away. So platforms help you manage the investor onboarding and reporting. They provide visibility, but your own audience and digital marketing will drive success, right? Bringing it back, they don't market for you. Broker-dealers are also limited in how they can market, because they're regulated by FINRA, and FINRA requires them to get approval for anything they send out digitally or even written, like a brochure, on behalf of the companies that they're representing. They're allowed to sell the deal, but it takes time to get things approved. So if you're doing it quickly, you don't work through a broker-dealer. Okay? If you want to be able to now you as an issuer can issue out all your stuff you want, right? But you always want to have this, forward-looking statement thing, right? And so you want to get the link for the free crowdfunding investing book, CF Early Bird, right? The Inside Secrets to Crowdfunding. Jane learns how to do all of this. It's not just about investing, it's about owning your financial future, right? You can download the ebook, The 4 Ws of Crowdfunding. It's a quick start guide to a powerful new wealth building vehicle designed to help you make smarter decisions, avoid emotional investing, and build a diverse portfolio. Pre-register for the new book, Inside Secrets to Crowdfunding Investing. Follow Jane's journey. See how Jane, I like the little play on terms there. See how a new generation is creating wealth with purpose, passion, and profit. On purpose, investing in things that you care about, that you're passionate about the problems that they're solving, and you intend to make a profit on it. That's what the compassionless capitalist movement is all about. That is what my Compassionate Capitalist podcast show is about. And that's it. So I hope that you have found this to be tremendously helpful for you and new aha moments. Throw it into the comments. go and share this with companies that you know that are stuck and want more capital. They want to bring out another product. They don't quite know how to do it. They can just at least have a free call to talk about it, right? Send this to them so they understand more. If you as an investor are thinking that you would like to have other options besides what you got with real estate and the stock market and crypto, then you owe it to yourself to at least get the ebook. Take a look at the thing. My birthday thing is I'm offering up. I'm not quite sure. I'm going to be 62. So I'm going to offer 62% off. 62% off the book, the course, and my existing book, Inside Secrets to Angel Investing, will be free in there. So heard it here first. With that, I would say thank you very much for watching. Onwards and upwards.